Good day, fellow investors. Today I'm bringing to you a company that I've been following for many years now, Petrobras. I would like to analyze the company through a value investing approach with you from the 4M's perspective, meaning moat, management, and margin of safety. Well, applying these 4M's to Petrobras' case, we can see that for the meaning part, we want to understand the company. What are we talking about? Is it within our circle of competence to understand this type of business? How is the money made? From a moat perspective, what long-term durable competitive advantages this company has? From management, you clearly want to have a management who is aligned with the interest of the company, working together. They are experts at what they do, and they have integrity. From the margin of safety perspective, you don't want to overpay. Maybe it's the best business in the world, but if you overpay, it's gonna turn out a poor investment. So for Petrobras, what is the meaning in a nutshell? How do we summarize these 4M's before we dive deeper? First, it's an oil major focused on exploration, production, refining, and distribution of oil and gas. Second, within meaning, it has a lot of political issues, and it's also dependent on global oil prices. It's a price follower. Moat, it's a dominant player in Brazil, a near monopoly status. Any JV or anything with oil in Brazil has to be fully owned or partially owned by Petrobras. That's just how it is, and it has huge power and ownership of critical infrastructure, of ports, of pipelines, refining, distribution, you name it. It is a huge offshore pre-salt portfolio, which is generally low cost and high output. And let's talk about management. So that's where this nice story kind of to start really to unravel. You have regular CEO changes due to political upheavals. Previous presentations, we can probably remember Bolsonaro changing multiple CEOs, telling them to lower oil prices and those kind of things. The executive board is reasonably paid, so they are not overpaid. If you look at their CEO to average employee pay, or just generally the numbers of the executive board is paid is reasonable, especially if you compare them to US CEOs and executives. Although the incentive structure is not as transparent as I would like it to have be. You can see for other major oil companies and generally in other companies, the incentive structure is pretty simple, clear goals, KPIs, everything's there. Not the case for Petrobras. A margin of safety perspective, it's cheap. It trades at a really low valuation compared to its peers, and the discount reflects sort of the political influence, state control, high local interest rates, and emerging market risks. So, for example, just the interest rate side, Brazilian 10-year government bond is trading just below 14%, while the inflation is 5.5%, I believe, the most recent numbers. So they have a huge, like 8% real rate in Brazil. And of course, it's an emerging market, so it has its own type of risk. Let's look at the meaning, the general overview of the company. So it's government controlled. You can see on the right side that the total share capital, 37% sits with the government of the total shares. But more than 50%, I believe 50.26% sits with the government of the voting power. So they make the decisions. They have a dual class structure. So you have the common and the preferred. The preferred usually trades with a discount to the common, but has no voting power, although it has a privilege, so it gets dividend first, but both gets the same dividend. So there is no benefit of holding the preferred over the common other than it's first in line for the dividend. But they get the same dividend these days. Political involvement risks. That's a huge one. Operation Carwash, sure heard of it. It exposed Petrobras executives colluding with contractors to inflate project costs and funneled billions in bribes to politicians. The scandal led to Petrobras paying record fines, losing massive market valuation, facing international scrutiny, and undergoing strict governance reforms. fuel price controls. So in the first Lula presidency, I think it was both terms his, you had basically price controls on Petrobras. It was forced to sell below market prices, and also bought a lot of oil from abroad, and they sold at home below prices. So it cost the company billions, huge debt load, bloated. The two combining, the Operation Car Wash, overspending on projects, and this fuel, the company was in a rough shape with a lot of debt. And yeah, and actually back to the common and preferred, the share structure in 2010, Petrobras raised like $70 billion in a record share offering to fund pre-sold oil projects. But that also changed the sharehold structure so the government had more say in things. That you probably influenced those two events, the full price controls and the Operation Car Wash. Having said that, in 2016, 2017, because of all of these scandals, the Operation Car Wash scandal, there were reforms. And if you read the reforms, I highly recommend reading it, because it's a good read. It's not that long. I remember as 16 pages or so. It has a really free market based approach and a spirit. It's really nice to read. It talks about corporate governance, to have more independent board, stricter appointing rules, that the non-controlling interest in Petrobras, which is the majority, not to be exploited. It reduces political interference, eligibility rules for executives and political appointees. Although there was a rule that you cannot appoint somebody who was part of a party in the past 2 years. But after Lula got elected in late 2022, that rule was changed, I think, to like 30 days. And then he appointed as CEO, his first CEO, since then that person was replaced, Prates. Okay, and market-based decision-making and pricing. So that was for Petrobras to not lose money and get into a lot of issues and debt going in the future. So approving and starting projects have to be economical, so it's not a political decision. And pricing is more dynamic and based on international prices. Petrobras is all of that, but is a leader in deep water production exploration. That's its niche, and we'll talk about that later. It has relatively nice amount of proved reserves. At current production, it's around 13 years of reserve to production. If you calculate in the growth they are projecting to have, it's still 10 years, but they have a lot of CAPEX coming, so probably that 13 years could be maintained. That's a lot of reserves. If you think about other oil companies, last number I remember for Exxon was like 12, 13, maybe 14 years worth of reserves. But there are companies like BP of 5 years worth of reserves, 5, 6. So it's on the higher end. They have enough oil for the foreseeable future, and a good reserve replacement ratio to not just run out. Okay, let's talk about geographic and segment breakdown. So revenues by country. Brazil, the domestic market, is by far the largest source, 72.5%, as you can see. Then you have China. You have the Americas, 3.9. Let me actually grab a tool here. Probably gonna help. Yes, Asia without China and Singapore. You have Singapore. You have the US. And you have others. So it's mainly Brazil, with some China coming in the mix, and Europe. It's not as exposed to the global market and to China as we would think, although prices are influenced and global, so that's a risk for every oil company. Net income by segment. You can see that 90% of their net income is coming from exploration and production, as said, because their deep water wells are highly cost efficient and productive, and they are the bread and butter of the company. After all the upheaval of following the car wash and the reforms after 2016, the company sold off a lot of assets, focused on the core, which is exploration and production, got leaner, got really profitable. And maybe now we see some change to that with move back into refining and marketing under Lula, but the core is still exploration and production by a large margin. Financial metrics. Okay, let's talk about debt to equity. It's manageable. So in 2024, it was 39%. In the last quarter, 35%. That's manageable. That's nothing outlandish. You can see the coverage ratio from 2024 annual report. 14. If you think about a Benjamin Graham perspective, you want to have it above kind of 5 coverage ratio. They are not drowning in debt. Another part is the cost of their debt. It's 8% as of 24, and actually 7.3% annualized based on their quarterly Q2 number, which is very interesting because the Brazilian 10-year is just below 14%. So they are basically borrowing cheaper than the government. Of course, they are, as you can see on the right, and maybe it's a good point to go to the right here, you can see that the total debt they have around 26 billion of finance debt, 8.2, so like 1/3ish is local in Brazil, and 2/3 is global. So it's abroad. It's mostly in US dollars, maybe some pounds. Although I would like to point to the arrow here. In 2024, they had a large loss in the foreign exchange loss regarding their accounting for the debt. So with that Brazilian real versus dollar FX moves, if you remember late 2024, the real was crashing against the dollar. That resulted in a paper loss, but it didn't really touch their cash flow. So it's just a paper loss. And I was curious to see this Q2 number, because as you can see from this point to this point, you see a substantial increase in borrowing locally, while the global, while abroad is kind of flat. So percentage wise, it's huge. It's like 30-40%. So maybe it's interesting. Why would they want to borrow at home instead of abroad? Maybe they don't want to have these large adjustments they need to make. Maybe next year is going to be a profit. So it just looks bad on their income statement. Let's talk about the current ratio. Current ratio is current assets divided by current liabilities. Late 2024, they dipped really, I think, below what they should have. From a Benjamin Graham perspective, you want to have at least 100% or 150% covered of the current liabilities. They dipped below that. Probably they paid out more cash as dividends than they should have. But in Q2, you see they kind of recovered a bit. They have no issue with debt payment or anything else. I would like to see them to cover it, to go back up 100%. Maybe they pay dividends slower or collect faster receivables. I just want to see this a bit higher. From a profitability perspective, you can think about return on equity. For 24, it was 36% return on equity, which is amazing if you consider that they don't have that much debt. And in over the past 7 years, so since 2018 through 2024, it was around 32%. So these are both great numbers on return on equity. And return on investment is also looking solid. So it also includes debt, not just finance debt, but they have other debts, mostly leases. These are not horrible numbers. This is a really profitable company, and they have much better profitability numbers than compared to, let's say, Exxon, Chevron, Equinor, Total. BP is the worst by far, but this is an outstanding company from a profitability perspective. Actually, that's also the reason why it's interesting that they are so discounted against other oil majors, because they are more profitable than all the others. So political risk is maybe that much risk, or maybe people think too much about it. But let's move on. So let's look at their capital expenditures. So historically, you can see that they had their cash flow from operations is the purple lines here, operating cash flow, and then you see the CAPEX, and then I also added depreciation, depletion, and amortization. So that's a generally a maintenance CAPEX equivalent for resource companies. So you can see if the orange line is higher than the yellow line, that means they are investing more in growth. On the other hand, in 2020, you can see that the orange line is far below the DDA, depreciation, depletion, and amortization. So that means they are underspending CAPEX. You see that 2020, 2021, 2022, 23 even, they were kind of underspending CAPEX a bit. But previous years, especially 2014, they overspent CAPEX. So today, Petrobras is last year they recovered to growth. For the 21, 22, you can also think about the situation in 2020 with COVID, companies restraining resources. In 2022, there was an election in Brazil, so they had really high oil prices, so we're just paying out. I think they paid out like $38 billion in dividends. That was like at the time 60% of or 70% yield on the current market capitalization due to semi-political reasons and also high oil prices. So because the government is a large shareholder, like more than one third, 37%, they get a lot of cash back, and then you can win an election with paying stuff to voters, so buying votes. You can see they are issuing these like 5-year business plans, and then you can see what they are planning to do. So an investment breakdown. They're planning to invest 111 billion in over 5 years. Exploration and production, as said, it's 90% of their net income. It's top. They want to focus on refining, transportation, and marketing segment, doing something with the new energies and gas. I hope this is mostly gas, especially because they have projects in Argentina on a gas field there. This could be huge. I actually like Petrobras doing some I want them to do more LNG. Maybe they could be a larger supplier to Europe and compete with the US on that front. But although that might cause political upheaval between Brazil and the US, but I would like to see that happen. Yes, and annual distribution of CAPEX. This on the bottom, we will use it for the valuation purposes to project out these discounting cash flows. But this is sort of the breakdown of the top part and the bottom, how it will look like in the coming years. And as you can see, actually, on the sanctioned part, not especially projects out, not everything is 100% there. So we see the trend that oil companies starting to cut back with oil below $70 a barrel, both Brent and WTI. I think Chevron is cutting 20-25% of its workforce, and ConocoPhillips, you hear about Occidental cutting CAPEX. So this CAPEX might be overly optimistic because it is late 2024, because this is the annual report and their business plan. So this all happened in late 24 when oil was more like $80. So we can see probably lower CAPEX if that's the case. Okay, meaning shareholder remuneration and approach. All right, so what's the company's policy regarding shareholders? They want to focus at quarterly distribution. They have a policy to pay at minimum $44 billion if the Brent crude price averaged above 40 per barrel that year. And in general, I think this is the key part here. In general, they will pay out 45% of free cash flow if gross debt stays at or below the debt level they define in the business plan, which is currently sitting at 75 cap. currently, late 2024, that was 60 billion. So they are comfortably below their debt limit. So we can expect 45% of free cash flow to be paid out as dividends. Of course, they can issue extraordinary dividends as they did in the past. And this also focuses on dividends. We will see it later. But actually, they, in the past 2 years, started to do small buybacks. Before that, they never did. But expect mainly dividends, not buybacks, which is, I think, an extra overlooked benefit, right? So you can have tax benefits with getting buybacks. So you get capital appreciation instead of dividends, which are taxed when you get it, not just when you sell it. But resource companies tend to destroy capital, actually, I think, with buybacks, right? Because let's think about iron ore producers. When you have sky high iron ore prices, your share is going to track higher. So iron ore prices go up, your share goes up. Makes sense. And you have a lot of new cash. What do you do with that cash? You buy back stock at the high prices. Doesn't make sense. And most companies do that. When their stock price goes up with the underlying resource, they have a lot of cash and they buy back shares at the high price. And when the resource, like today iron ore, goes down, their cash generation goes down, their stock price is down, and they don't have cash to buy back the stock when it's actually cheaper. So it's I think, a big negative for resource companies to have an approach like that. Some companies try to just even it out, so they just distribute quarterly dividends and then they just stack up some cash. Most companies just flush out a lot of buybacks, a lot of dividends at the time when they are at peak. I think the best they can do is maybe issue dividends, and that's it, and not to buy the stock back at high prices, because in the long term that destroys capital for the shareholder. So I think this is a plus, that they mostly do dividends. So this is the Petrobras policy, but actually in Brazil you have a law that companies must distribute a mandatory minimum of dividend of 25% of adjusted net income. That's a nice minimum they're gonna pay. All right, so what does it look like going forward? I could do my own research and I have my projections, but let's look at what the company says they're gonna pay you. So this is how the 5-year plan looks like for them. They're not gonna do much borrowing. They're gonna be mostly operating from operational cash generation. Okay, they're gonna invest. We know. Leases, right? They have a lot of ships. What we are really curious about here, and yeah, this is debt payment and other expenses on that, is dividends. What do they gonna pay us, right? So if we talk about this amount, this is over 5 years, so you have to divide it by 5 to get an annual rate. You would get like 11% to 14% ish as this baseline. So this part. If they add the potential dividends, you are looking at 12.5 to 16%. So that is what they are looking at and projecting to give out as potential dividends. And we are not talking about extreme oil prices, because they are saying they see $68. So we are there. Today we are at 68. They look at 2029. Okay. We'll see how that works. You see some sensitivities here. If Brent goes up or down, it's like 5 billion for 10 a barrel. And then of course we have to think about crack spread, economic macro, how this works, and then how the real changes. But the good part about Petrobras, I would say, is that they're operating with oil, which is a dollar traded instrument. So what's their FX risk there, right? They're selling at global prices, which are in dollar. Their cost is although mostly in reals, so maybe they actually benefit from a weakening reals. This part I don't like. 83 per barrel for 2025. First quarter was 76 for them, 75.7, and the second quarter was like 69, 68. So they are already at like 72 on average for the year. So this is too much. Maybe they're gonna cut back CAPEX, but who knows? We have more than a quarter left from 2025. Oil prices could go up. Yes. Let's look at the dividend history. Everybody wants to look at that. Okay, how does it look? Petrobras 2018. You see purple in the free cash flow. Dividends are orange and the buybacks are green, yellow. You can see that the leveraging phase. Actually this is not the deleveraging. They did deleverage here also, but they had a lot of capex going in. If you recall the previous slide on capex. COVID, right? They reserve cash. They don't pay out that run dividends, and of course oil prices were down. And now we had 2021. Dividends are picking up, and this is the 38 billion I talked about. 2022, you have record oil prices around $100 a barrel. You have an election, so that's something to keep in mind, is the election cycle in Brazil. In this particular case, Petrobras kind of used, Bolsonaro kind of used Petrobras as a guinea pig for cash for the election. As you can see, they almost paid out all the free cash flow they had, and they were scrutinized by others that it's causing the company to be less stable without cash. You basically empty the company. So that was 2022. We'll see about next year's election, how that turns out with Lula. And then in 2023, so this is the first year of Lula, second year of Lula, you see they started to do buybacks. That was a nice stake, I think, because Petrobras is undervalued compared to peers. So here, actually, it makes sense to buy back stocks. Actually, during the 22 elections, you had $100 oil, 90, 100 barrel oil, and Petrobras dropped below $9 a share because Lula won the presidency. When the first round, Bolsonaro performed okay-ish, the shares rose like 12% in one day because Bolsonaro said they're gonna privatize the company and get the government risk out. Of course, Bolsonaro was doing a lot of interference from a political perspective, so it was not like he's a totally free market guy, but that was the sentiment, kind of holding down Petrobras with Lula below $9 a barrel, and oil is trading at 90 or 100. So that at that time, I think Petrobras was selling basically 1.5 times free cash flow. It was like 60 billion, 50 billion, and then they had 40 billion free cash flow. I was looking at it like, how can you lose? This is crazy. So 23 they did some buybacks, 24 they did some buybacks, but they try to maintain the dividends more than they focus on the buybacks actually, because it's government owned and the government prefers to have cash. Okay, look at the moat of Brazilian business, of Petrobras business. So it has a huge domestic exposure. It has a near monopoly status in Brazil. Ownership of vast pre-salt offshore oil reserves, low-cost, high-output fields. Reserves and production are overwhelmingly domestic. As you can see, 99% of production, of reserves, and most of the assets they have. This is a hidden moat, I think, for Petrobras, because they are out from all the Middle Eastern misery, all the conflicts, all the explosions, terrorist attacks. They don't have to deal with that. They just benefit if prices go higher. Okay, other than Brazil, what do they do? Well, they move to Africa. They say the deep water structures, geological structures are similar in this west side of Africa than to what they experienced in Brazil. So the tectonic shifts here. They have similar structures, so they have the expertise. They are working with Argentina and exploring a large Permian Basin-like field, and other parts in Latin America. So this is the growth phase. I like it. I like that they have most of their stuff in Brazil, but there are potential with these. Let's look at the other mode, which is relative low-cost producer. As a price follower, as you are with an oil company, you want to have the lowest cost possible. Petrobras says they have $28 per barrel break-even price. If you use 65% of their projected capex, it's 35, and $45 a barrel to cover most of their capex ideas. Personally, I did my calculation. Pre-tax, it's like 35 to break even, but that's me. That's my calculation. You can see overall the cost curve of the supply. So you see that Canadian oil sands are really expensive. You see Russian offshore. Actually, US shale is also kind of higher. And deepwater sits at 43. It's kind of middle of the pack. Of course, these are new productions. This is the producing ones. But I think a better look could be made at this is late October 2024, and the 2022 research I found shows actually companies. You can see Petrobras kind of less than like the middle of the pack. They are even cheaper. You see that Canadian companies are usually more expensive. Occidental, which is a US shale producer, mostly shale. BP, these are all higher producer companies, which means if oil prices drop further, they have to switch off new CAPEX, new supply, because it's not profitable at that range. Let's talk about management. You have transient CEOs, as I said before, political reasons, replacing them, and that's not really stability for the company. On the other hand, how do they get paid? You have multiple ESG metrics, so greenhouse emissions, oil leaks. You can agree some of these can make sense. Dow Jones Best in Class Index. These are ESG indexes. I would prefer to have more of this delta value, which is economical financial KPIs. Although oil spills do make sense, but I think these two makes most of the sense. And my issue with their incentive structure, other than you have a lot of ESG there, is that delta value is not detailed. What do you mean? Do I mean cash flow? Do I mean cost? Do I mean profit margins? What do you mean? Do you mean debt levels? So it kind of generally says that it's tied to the business plan, which has, for example, debt levels. So I guess that. But if you look at total compensation, they are not overpaid by far. Like they have 9 people on the executive board, and in total they get $7.2 million, so less than $1 million each on average. Compare that with Chevron, 32, Exxon 44, or even Total 4.4 only for the CEO. So these are not overly obscenely overpaid executives. I think that's a plus. Margin of safety valuation. So this is the bread and butter for this video. Actually, I want this is my calculations. So I use a 10% discount rate. So that's my rate of required rate of return. They are cheaper compared to peers. If you look at first valuation method, it's just a historical number. So you look at how much would the company cost per share if I get a 10% free cash flow return. You can easily calculate that. You grab the free cash flow and 10x it. You basically end up with $33 per share. And the 7-year average is basically the same approach, but you use 7 years average free cash flow. This is backward looking. This is just ballpark context. What I think is much more useful and much more accurate is a projection. How do we project? We have a pre-tax break-even number. We have the CAPEX numbers, which come from our CAPEX projections, which the company provides. And we also want to know how much they're going to produce. That comes from their production outlook. So merging all these together, we end up with a 10% discount factor. We end up like $24 per share. And at that rate, you get 10% free cash flow from your investment. 45% should come to you as dividends. But that's, if you would be the sole owner of the business, that's a 10% return for you. So looking at the projection here to end up with 24, I used higher CAPEX, right? Because as discussed, when these CAPEX targets were made, oil was 80 a barrel or more. Today it's lower, and competitors and everybody is cutting CAPEX, cutting staff. So maybe we get lower CAPEX, then this number goes up. And a more conservative break-even used. So company says 28. break-even price, 35 with CAPEX, but I deduct CAPEX separately, so I just want to look at the break-even. I didn't use 28, I used 35. I calculated it myself. I think it makes more sense, and at least it's more conservative because of a higher number. And oil prices were used at 65 to 75, as you can see here on the outlook. So that's how I ended up there. It's kind of a ballpark number. Plus 10, 20% doesn't change really the picture. As a summary to the video, I will provide the stock summary table, and every time we add a new video, I'm gonna add a new company to this list. So now we only have Petrobras, and then you will see a summary of the company's name, industry, where it's located, current price, calculated intrinsic value, what's sort of the upside here, and then some key metrics of current debt to equity, current ratio, coverage ratios for average in the past 7 years. I think that's also crucial to see in a historical context how the company looks. And then the 7-year average KPIs go forward. This is a price to free cash flow. It's sort of like a price to earnings ratio, but I prefer free cash flow to earnings. And then actually I use free cash flow for all of these numbers as well. Free cash flow margins, return on tangible assets, return on invested capital, return on equity. You see great numbers for an oil company. And then this is your free cash flow year if you look at the 2024 number. So I hope this video was really useful for you. Please let me know if you have any ideas of what companies to look at, if something I missed or anything else. I want to expand this video. I got like 32 other companies already analyzed. I just have to make a video about it. But if you have an idea, a company you want to see, just let me know, and then I can start with that. Thank you for watching, and see you next time. Take care.